Hello traders, welcome back to the channel. Today we are going to look at a trade in AMD. First, looking at the chart, you can see AMD is neutral on our DK bar color indicator. This indicates it is not currently in a strong up or down trend. Price action is sitting right around its moving averages, which should reduce volatility as some are acting as support and others resistance. The 200-day simple moving average is the key support level down at 98. The lower limit of our DK trend channel is 94 and the upper limit of the channel is 111. These levels also roughly line up with the expected move priced by the options in this cycle. We are going to set up a similar trade to the one in Amazon we discussed in the previous video. We will capitalize on the fact that implied volatility, IVR, is currently still high at 49.8. Most of this year AMD has had an IVR 30. We are betting that implied volatility will contract over time, and if the market moves, we will move with it, adjusting the trade. Today is October the 16th, so we are going to look to the November 17th options expiration for this trade. We are looking to risk only $1,000, not counting the net credit received for putting on this trade. On this trade, so each spread will be $10 wide in this iron condor. We want to enter this trade by selling the Delta 20 call and put. Looking at the options chain, that will be the 95 put and the 120 call, which are closest to a 20 delta. We can now spread off these short options with some long options to define our risk. We will buy the 85 put and buying the 130 call, so we have a put spread and call spread that are each $10 wide. We can sell this whole package for $2.71. This is a positive theta trade of $6.67, meaning if the price stays the same, this trade will lose around $5 a day as time goes by. Looking at the trade analysis tab, we can see that our trade will be profitable if the price action stays in between our short strikes of 95 and 120 at expiration. But we will look to take this trade off before expiration. In a perfect scenario, price action will hold between our short strikes, and we will close the trade when there are only 21 days remaining. The passage of time alone should reduce the value of this trade so that we can remove it for a small profit. Remember, we sell to open, and we buy to close. So we want to sell the trade for a lot at the open and have it reduce in value so we can pay less to buy it back to close the trade. Of course, if we can pull $100 notional, meaning $1 per lot out of the trade, or IVR drops below 20, we will take the trade off for a profit early. At any time during this trade, if we are tested on the short put or short call, we will roll up or down the untested side to receive a credit to reduce our losses. When we roll the untested side, we will roll to the new Delta 20, and if necessary we can roll our untested short option to the same strike as our tested short option. At that point in time the trade will more than likely be a loser, but we will have reduced the maximum loss by a substantial amount. The last thing I like to do when entering a trade, is to plot a reminder for me on the chart. I will place a note here on the chart denoting my short strikes. We can see our short call is at 120 and our short put is at 95. Well, that is the trade for today. If you could, it would be great if you would like and subscribe. Thank you for joining. Until next time traders.